Hey, welcome back to the Mining Pod. On today's show, we're joined by Asher Genoot. He is the CEO of Hut 8. He's been on the show a few times. This time, we're going to be talking about their new unit with Bitmain and a new hosting deal they're doing with Bitmain. So we're going to talk about the hosting deal that they've structured with Bitmain, the unit itself, how it sort of fits into the traditional data center world versus other form factors for Bitcoin mining, and then just the opportunity cost for these different investment profiles that we're seeing pop up on the market. This is one of the quicker shows. 30 minutes to learn a little bit about this deal. So sit back and enjoy. But first, a few words from our sponsors.
Accelerated by Compass is the premier accelerator program for Bitcoin mining sites at any stage of development. Our managed services provide expert guidance in site procurement, construction, energy agreements, and mining operations. Compass helps clients meet timelines and expectations for operational excellence, from greenfield to retrofits and everything in between. Don't just mine, excel. Visit compassmining.io now to discover how Accelerated by Compass can power your success.
Are you a retail or institutional investor interested in Bitcoin mining companies? The Miner Mag brings you free data and analysis from all major NASDAQ-listed Bitcoin mining operations to know who stands out. Check out visualized metrics and data-dependent stories at theminermag.com.
Hey, welcome back to the Mining Pod. We're joined by Asher Genoot, longtime member of the Mining Pod community, I'd say. It's the third show we've had you on, and we're going to have more people from Hut 8 on soon to talk more about stock. But today we're talking about the new unit that you guys are deploying with Bitmain. But welcome back to the show.
Thanks for having me. Excited to be back.
Yeah, I'm excited to talk about this unit. So for listeners, this one's going to be like more focused on ASICs, Bitmain, building relationships with them, and then this U3 S21 EXPH unit, which is quite the mouthful. It's just a beast of a unit, and it turned a lot of people's heads. 860 terahash at 13 joules per terahash. And as we were just discussing before, Asher, like this is more of like a traditional server model, right? Where a lot of people are thinking of chicken coop, put the Bitcoin miner in my little hut and then I can run the air cooled stuff. This is not. This is like we're going back to the traditional world. So tell me a little bit about this unit and tell me about how this came about.
I think this unit is the first unit designed and manufactured on commercialized scale that is built for an institutional miner, right? If you think about the form factor of traditional mining equipment, there's really for folks buying a couple of units, and then large scale miners just continue to buy that, where you just put the machine on the rack and you put them in chicken coops or in containers or whatever it may be. When we thought about how do we grow our self-mining business and how do we scale where Bitcoin mining is going, our focus was on where is the puck heading? How do we innovate towards where that's heading? Not just relative to the Bitcoin and ASIC side of the business, but also our overall platform that we're building, and how do we start synergizing supply chains? And so we've been pitching kind of the manufacturers and Bitmain on, we need to rethink the form factor. And funny enough, actually, back in 2021, Eric Schmidt ended up investing in our company through one of the funds, and I had a call with him. And his first question on the call was like, why do you guys have these like box ASICs? Like, why are they not rack designed with blades that kind of just slide out? And so a couple of years later, we finally were able to bring that to fruition. But the idea is, where do we believe our industry is heading as we think about deploying capital and to continue to grow and to step function increase in terms of like being the miner of kind of this next phase? How do we think about not just increasing self-mining hash rate, but the efficiency of that hash rate, the form factor of that hash rate, and the capital structure of how we bring it on? So we're really, really excited for this miner. It's a beast, as you mentioned, 860 terahash per unit, 13 joule efficiency. And when we think about the racks that we're designing, it's a traditional data center rack. So when you walk in, you'll see kind of traditional data center halls, and it's direct liquid to chip. So it's liquid cooling, which is really important because a lot of kind of the AI revolution is all liquid cooling as well. And so there's a lot of synergies in how we're innovating there. And then lastly, like density of compute. So each rack with the miners in there is going to be at about 180 kilowatts per rack. To put into perspective, like traditional data centers, air cooled, are, call it 10 to 20. The H100s that NVIDIA came out are around, call it like 40-ish kilowatts per rack. The Blackwells and the liquid cooled that they're coming out are above 100. And so at 180, like this is one of the most dense racks. And that's what we're excited by, because we're now kind of moving where the puck is heading and continue to build for what the future of this industry looks like, rather than just adding on self-mining hash rate and being in that rat race.
You mentioned two things in a Twitter thread you did about this on the 23rd. We're recording this on October 2nd. And I think it's coming out next week, so around the 5th or something like that. But you said there's two challenges catalyzed our partnership with Bitmain. First was the recognition that we are on the cusp of a step change in ASIC chip efficiency. And the second was the question of why Bitcoin mining facilities still use the shoebox. So you just mentioned the shoebox stuff. Let's go back to the ASIC chip efficiency. From like a larger perspective of someone who's like not really paying attention to ASIC chips, but might know what they are. What is this cusp that we're on? What's changing here? Is it about the efficiency from under 20 joules per terahash, or is it something about the wafer size, or how are you guys thinking about that change?
Sure, it's both actually. In regards to kind of the step function efficiency change, the kind of most efficient machines were around, call it 18 joules per terahash. And then Bitmain came out with this kind of 12, 13 joule per terahash announcement, which is a massive increase in efficiency that the other competitors from a manufacturing perspective haven't been able to catch up to, right? Everyone else is still producing between, call it 16 to 18 joules per terahash. And so from an efficiency perspective, when I took over as CEO in February, I had a lot of pressure from the market to go and buy new machines and upgrade. I mean, our average fleet across self-mining is 31 joules per terahash, but we had a good inkling that new machines were coming out, they were going to be more efficient. And so our thought was, do we spend the money now to go buy machines and bring it from 30 to call it 17, 18? Or do we try to jump one step ahead to 12 to 13 and basically skip a generation of machines? And so that has been really, really important. When we think about the life cycle of when to invest and where we are in terms of machine efficiency, if you think about kind of the chips, the 2 nanometer chip has been announced for years with TSMC, and they're finally kind of rolling it out and people are taping out and testing it, but they haven't announced a 1 nanometer chip. And so when we think about kind of the efficiency decay of the chip, we do believe that there'll continue to be improvements on efficiency, and probably by end of next year, we'll get into like high single digits, but that's a much slower rate of increase in terms of efficiency. And we don't see as much capital going into them because a lot of people bought the machines that are 16, 17, 18 joules per terahash. And so for us, we thought this was the right time to deploy, but we also did so in a way where we didn't just go and buy 15 exahash of machines. We did it in a structured manner where we basically have a look at what hash price will be when the machines are running, rather than take a 6-month bet ahead of time, hoping that economics will still remain where they are.
Love it. Okay, well, we'll go back to the units in a minute because I want to talk about some of the other people who are on the market and why you guys didn't pursue that. But let's go back to your Twitter thread and you talk about the different cooling solutions that are not possible with this model versus others. How does this compare to the traditional server world? You already mentioned this, but I want to kind of clarify and double click on it. How does this compare to the traditional world? And then how different is this from other forms of like immersion or hydro that we do see on the market available right now?
So comparing this with other use cases outside of Bitcoin mining and ASIC, specifically kind of on AI, direct liquid chip compute, I think the question is, how do you cool servers in a dense space, right? And so when you think about it as like a 48U rack, how much cooling can you cool in terms of heat dissipation within that rack server? And so this design is going to cool 180 kilowatts per rack. We're actually designing the racks to cool a bit higher than that to allow for flexibility as kind of we increase sizing down the road and think about kind of where the puck is heading as well. But that is much more dense than even kind of the next generation NVIDIA chips coming out. There is a difference ultimately in the infrastructure. We're optimizing these sites and we're not building a ton of redundancy like UPS backup, generator backup, which traditional data centers need because they want the redundancy. And so for us, when we think about building, like we're not trying to find this middle ground between AI data centers and Bitcoin mining, because ultimately what like is the issue there is you're not spending enough money to provide the right infrastructure for the AI chips, and then you're overspending money by putting Bitcoin chips in there. Right. And so we've told the market, we're going to build this site under $400,000 megawatt. That's like 30 times cheaper than like data center builds, right? Around $10 million a megawatt. And so we're still focusing on costs and being super efficient. I think like some of our peers are building air facilities for more than $400,000 a megawatt. And so I think it's still extremely efficient. we're being conservative in how we're building as well. We're oversizing some of the equipment as we're kind of testing, optimizing. So we believe those costs will come down over time in addition to where we're at now. And overall, in terms of innovation, there's been air, there's been hydro, and there's been immersion in the markets. But they've all been the same form factor. And we kind of talk about this shoebox form factor, which is like this big unit that is clunky. And even when you think about, so from a perspective of air, you put it on these racks that you have, and then you try to use forced air if the environment needs it in terms of cooling down that infrastructure, the chicken coop buildings that you've seen, the containers. Then when you go into immersion, you're either retrofitting those units and taking out the fans and things, or you have kind of these immersion units that you dunk into these tanks. And we can go into our thoughts on immersion momentarily. And then lastly, hydro. Hydro was also built with these shoebox design factors, and the densities weren't as cool. You didn't really think of things as like a rack design of how many servers you fit in a rack. And so we completely flipped this upside down. Like, why do we call hosting instead of co-location in like a tenant lease? Why do we have these like servers in this rack, in this shoebox design, rather than just a data center rack design? Why are we not thinking of hosting more as kind of a kind of co-location agreement, triple net lease, or gross modified lease? So really thinking about these two businesses, they're not that different. What's different is the risk profile, volatility of Bitcoin, hash price, credit-worthy counterparty, but like, is a large manufacturing counterparty or publicly traded company as your counterparty to the contract less creditworthy than a startup AI company? I don't know, right? If you compare with the hyperscaler, then yes, there's a big difference in creditworthiness. And so I think it's starting to normalize these together, because at its foundation, like, we think about the business in three layers. It's power infrastructure. Do we have access to interconnections, power, land, substations? Then it's data center infrastructure. Are you building a tier 0 low redundancy or tier 3 data center with full redundancy? And the third is compute. Are you putting GPUs or are you putting ASICs? You don't even have to call them Bitcoin mining miners. They're ASIC chips, right? And so I think that is like really how we're thinking about the businesses. Ultimately, when you're building a substation, you can decide to build more redundancy or less redundancy, but you're building a substation. You're building that electric distribution. And so I think the more we start like converging these technologies and how people think about these businesses, I think the more velocity you'll get in growth. And for us, we'll be able to synergize supply chains. We'll be able to test different innovations on what we can bring to both sides of the table. And so that's what we're really excited for. I think from a technology perspective, this is institutionalizing Bitcoin mining in both form factor and supply chain availability. Because otherwise, if you went with traditional hydro, you'd have to use like just manufacturers that cater to this industry. But if you're using a rack design, now you can use any manufacturer that delivers to these two data centers, because it's all rack designs. Obviously, different nuance on how much redundancy you want in the ecosystem, what type of cooling you want. There's nuances in the build itself, but the actual components, we're trying to kind of really converge those paths.
In the competitive world of Bitcoin mining, one name stands out: CleanSpark, America's Bitcoin miner. At CleanSpark, efficiency isn't just a goal, it's our standard. Our sophisticated facilities are built and led by expert teams who care about Bitcoin and the communities we work in. Scale, we've mastered it. Our large-scale operations have set us apart in the industry as examples of community-oriented building. Our track record speaks for itself. We navigate the complexities of the new economy with precision and with skill, continuously achieving operational milestones. Curious about how we do it? We invite you to discover the story behind CleanSpark's success at cleanspark.com.
How does this work into building a data center? So you guys obviously have your vendors and your pipelines for Bitcoin mining that have been established now for 6+ years as a publicly listed company, probably longer than that as a mining company. How are you guys working with new vendors who are in other data center lands? What are some things that you're looking for as a Bitcoin miner? Like, is there any like bespoke needs, to kind of use that fun word? Or is there anything is it just that simple? You can just kind of plug and play? And then follow-up question on this. Sorry to keep throwing two questions at you at a time. I'm curious about like repairs and how you guys go about that process for a new unit like this. It's always a concern when we see a new Bitmain unit come to market is the aftermarket parts and supplies and the training for fixing these things.
So I'll answer the first and then I'll go to the second. In terms of kind of the the first, a traditional direct liquid to chip cooled data center for AI compute, there are some critical key components that exist there that don't exist in a mining facility. Generator backup systems, UPS battery backups, right? And then redundancy when you think about your electrical distribution up to your substation and so forth. So there's a lot of these areas that aren't being built within when we think about Bitcoin mining. And as we're thinking about future sites, we can think about, can we create enough room and space to think about those redundancies? But the way I think about it is you have one extreme, which is plus or minus $10 million a megawatt to build. You have the other extreme at around $400,000 a megawatt. Both of them do three things. They cool the chips at a rack level up to potentially 180 kilowatts per rack, right? Less for the NVIDIA chips right now that are needed, but they have the cooling mechanism to cool up to 180 kilowatts per rack. They have the power that goes into the racks, and they have the fiber connectivity. The big difference is the redundancy to guarantee uptime, where Bitcoin mining, you don't need that. And you actually want to trade and you curtail the sites a lot relative to the AI data centers where you just care about bringing those online. I do believe down the road, and this is not in the next 1 to 2 years, but we think kind of 3-5 years out, there will be data centers that are willing to take a little bit lower redundancy, specifically for GPU and training, because those are not customer-facing compute needs. And if they're able to build sites more quickly, be more optimized, we do believe there's a world there, and we're excited to be hopefully a part of that innovation of where that world is. And so you'll see kind of the spectrum of 400K a megawatt, 10 million a megawatt, and I think there'll be some innovation somewhere in between in the road that comes out. I think today people just want to build the full redundancy as quickly as they can to kind of power where AI is going. But
Gotcha.
The overlap is, how do we cool these? How do we drive power quickly? And how do we drive access to internet connectivity? And I think something to like really think about is, look, we announced this deal, we broke ground on this site, and we're planning to have this site online in Q2 and early Q2. And so call it in a 6 plus or minus month range, we're bringing over 200 megawatts online of direct liquid cooled data center facilities. And I think it'll show folks our ability to not just deliver Bitcoin mining air cooled facilities, but to deliver a liquid to chip cooled facility. So that's kind of the first. Second, in regards to like, this is a new miner, what's the risk? And what about replacement parts and so forth? I mean, that's another reason we kind of structured the deal that we did with Bitmain. Like when we start in the first instance, we're hosting for Bitmain. And the hosting agreement actually is more revenue than we're making on our miners today at 31 joules per terahash. We're making more on that hosting agreement from a revenue perspective than self-mining. And what that does, put kind of the self-mining piece aside for a second, but what that does is have full alignment with Bitmain that all of their resources will be there to make sure these miners are operating. Because if they're not operating well, we're not fixing them well, we're not going to buy them, obviously. We want to buy them. We want hash price to continue to be where it is, or hopefully rally in the year to come. And so I think we have a lot of support from Bitmain because they're seeing this as their own right now, and they're putting all their resources behind it. And it's important for them because if they want to sell this form factor into the market, I think how we do is going to set the stage of their ability to mass distribute kind of this next generation of mining into the market. And then we can talk about kind of like this kind of host to buy model and why we think it's super interesting and the novelty around that. What do you want to chat about it?
Yeah, no, let's go into that next minus one question first. And that's just around the structure of this deal, which you mentioned a second ago. And it's kind of interesting. I just want to walk it out a little bit more for listeners. You guys are building this more traditional data center model, and you're plugging in Bitcoin miners. And it seems that by plugging in Bitcoin miners, you are able to keep the cost low for the structure build and for the entire build. And then maybe in the future, you guys are able to plug in those GPUs when it's cheaper. Would that be like sort of like a fair line of logic there? Or do you think this place will never be used for GPU mining and like AI kind of inferencing?
I think there's been folks in the market that have said, hey, we can convert like our buildings over and we can add redundancy and so forth. Like if customers are willing to do that, I think this site will be able to do that more so than existing Bitcoin mining sites. But I do believe the big difference between this full redundant ecosystem of like AI data centers versus this lower redundancy. Candidly, we're also having open conversations with potential customers on the larger data centers on like, hey, you want to do a pilot to like innovate where this could go with low redundancy. So, but I think it's dependent on, is a customer willing to kind of take that step forward and trying to innovate where like these are going, or is that going to happen a couple of years down the road? So I don't want to kind of say, hey, we're just going to like, from a practicality standpoint, the servers are data center racks. We can remove an ASIC and we can put in a GPU. Like it will fit in the rack perfectly. It will cool that rack. Power will get there. Internet will get there. The question now is, all right, if you're spending $30, $40 million a megawatt for those servers, do you want the redundancy to make sure you have all the uptime in the world? Whereas we're building right now to be able to trade around the energy prices like a Bitcoin mining facility does and has the ability to do so. And so I think it comes down to the customer and their willingness. But from like a practicality standpoint, like it has the ability to do so. But I think from where the industry right now is, the demand is still around, we want this full redundancy data center.
Okay, perfect. Thanks for letting me clarify that. Yeah, let's go into like the hosting model here. This is a pretty cool idea that you guys concocted. So it's like 15 exahash. It seems to be like over a period of time. You guys are getting up to 20 exahash. And then Bitmain's going to be hosted within your guys' facilities. Tell me about how that deal was structured, and then also just like the willingness for Bitmain to be able to do this. Because I definitely have gotten requests from both the Bitmain side of stuff and then the like other like, you know, market for mining to learn about working with each other. And it seems like it's hard to make that happen, and you guys got it done.
It's not easy. It takes a long time, and it takes a lot of trust between kind of the relations. We've known Bitmain since as early as kind of 2016, 17. And they've seen us operate and manage through the volatility of the highs and lows. And realistically, like we haven't purchased the majority of our machines from Bitmain. We bought a lot of our machines from MicroBT. We bought machines from Canaan. And so like maintaining that strong relation without just being their leading customer, I think is like a novelty because you're not just kind of spending the money to build that relationship. But I think they've seen us execute and they have confidence in our ability to deliver. I mean, they're giving us over $300 million of equipment to run for them. And if we don't purchase the machines, they're trusting those within our hands to operate for this new form factor. And so I think when we think about this deal, there's a couple of different layers. One is the trust in them to sign a hosting agreement with this type of machine and making sure that they trust it's going to go well and they can trust $300+ million of equipment with a partner. The second is like trusting us to be partners in them and how to think about where these chips should innovate and how they should go in the form factor. So I think the innovation in the form factor is like most manufacturers don't want to change what they're doing. They want to build their own product roadmap and they don't want to kind of collaborate in doing so. And them agreeing to not only allow us to be a part of that, but also allowing us to announce to the world that we did it with them, right? Like that's another element as well. They could have just said, can't tell anyone, like, well, we'll let you be the first customer, but we can't tell anyone we co-developed this. And then the third is like the structure in which we did it. And we said, look, hash price is volatile right now. We've told our investors that we want to be sensitive to our shareholders and like to accretion on like capital deployed. And right now, like at $21 per terahash, like we think like that's not the cheapest miners out there. And like when we think about modeling return paybacks and so forth, and also who knows where hash price goes next year, it can rep up and Bitcoin can go up and to the right. But if it doesn't, we don't want to deploy this much capital with that risk out there if we don't know it's going to drive accretion to our return on capital invested. And so we deployed this model where like they are the hosting customer. It's a really like great hosting agreement. It'll be about $135 million kind of run rate annualized base like revenue that pays back a lot of our costs of actually building the data center, right? So if you think about it on an unlevered basis, we get paid back quicker on our capital than a traditional data center. But with a traditional data center, you can lever up 70 to 80%. So you look at it a little bit differently. But just on the hosting agreement alone, it's a great agreement, pays back all of our building costs around kind of a year mark, and then we get profitability after that. So that alone is good. It allows us to test this new miner that comes out and work out any kinks without us just having to own the machines and take the risk there. And then it gives us this call option on Bitcoin and hash price, where if Bitcoin rips, we have a fixed cost per terahash of mining equipment. And I mean, you saw what happened in 2021. Machines were worth $60, $80 a terahash at one point. And so we have fixed price for the first 6 months of that of when we start plugging it in. If we decide to buy it immediately, we essentially got like 6 months of free financing where we don't have this capital out there. That's probably worth, if you think about $300 million cost of capital at like 10 to 20%, I mean, that's worth like $20-30 million for that like 6 month financing if we assume we buy it day one. And then if hash prices are kind of where they're at and they're not ripping, we can also have a conversation with them on like, hey, like, can we rethink like what's the best way to kind of buy this? They're in the business, obviously selling the machines. And so I think it's a really great way for us to grow thoughtfully, for us to innovate technology and like get support from like leading manufacturers in the success of our growth. And I think that's important. And we're seeing that here. And also like on the AI side of things, when we announced this deal, people were like, what? You're cooling 180 kilowatts per rack and you're getting this thing online in the beginning of Q2? Like we've had a lot of like our AI counterparties, like from the manufacturers to the O&Ms to the customers, like reach out and we're getting calls and we're walking them through this. And we're like, look, this is not an AI data center, but like we're cooling with this density. We're bringing power to it, we're bringing fiber access to it. And this is what we're building. And it's like, I think it's opening this way of thinking. Was before it's like, oh, Bitcoin mine, irrelevant. But it's like, wait, you're creating a liquid cooled facility at this density. Like, let's double click on that.
Interested in Bitcoin scaling, startups, or learning more about Bitcoin Softworks? Join us Saturday, November 9th at the Fidelity Center in Boston, Massachusetts for Op Next, a one-day conference on scaling Bitcoin hosted by Blockspace.media, the producers of this podcast. Join Bitcoiners like Peter Todd, Portland Huddle, and more to discuss various Bitcoin proposals like OpCat, the Great Script Restoration, CTV, and more. Attend workshops, speaker sessions, and panels discussing the latest in scaling tech, from ZK to ARC to Bitcoin Softwork history. And for a limited time, use code OCTOBER to get 25% off a general admission ticket. Find out more by visiting opnext.dev. Again, that's October at opnext.dev. You can find out more by checking out the show notes below.
Did you guys disclose the location for this hosting partnership?
Yeah, so this will be at the Panhandle site that we announced, a 200 megawatt Panhandle site. So we're calling it Vega. And so that is a behind the meter wind farm. So it's 205 megawatts behind the meter at a wind farm. It's also interconnected with the grid. When we announced the site, people are like, well, you're connected to a wind farm. You're not going to get power half the time. And I was like, no, like we're connected to the grid. We can get power 100% from the grid if the wind farm isn't there. But now we have like cheaper power from the wind farm, and we have clean power and like a good renewable story as well. And then in the main reason we didn't allocate that for the AI side of the business is like we've talked about our development pipeline, and we have a gigawatt of like assets under exclusivity, and we have a lot of projects within there and other sites that like customers have found like very heavy interest and demand in, and we don't want to kind of like go and try to do 10 sites at the same time. We want to like focus on a couple and lock them in. So there's 3 sites that we're spending time in and trying to commercialize on the AI side. And we told this wind generator that like we would start consuming power in the beginning of the year. And this was our fastest way to consume power. And this only takes up a small footage of the land that we can basically expand into and having the ability to kind of grow into. And so from our perspective, it's like, okay, great. If we want to put AI here, why don't we just put this Bitcoin mining site? We have an 18-month agreement. We can either buy this and leave it there, and we have other sites in the pipeline, or we can build a traditional data center alongside it. And like during that period of time while we're building, we've made all this money already, and we got all this option value on Bitcoin as well.
And what are you going to do with the rest of the land? You guys going to start a ranch or something?
No, we're starting to own a lot of land around the world. So, we're excited. There's another property that it's like we own, like we have a purchase order for hundreds of acres, and it's cool. I was telling the folks, I was like, we should go on like a wilderness trip there before they go and like kind of clear up the land and so forth. Yeah.
You guys should do like a Hut 8 investor retreat there and do like one of those like pig shoot events things.
Yeah.
That would actually be pretty dope. So let's kind of finish up talking about the opportunity costs for these sort of things. So you guys as a Bitcoin miner are not just, plugging computers. You guys are investors and stewards of capital from the public market and from institutions who want to invest in a Hut 8. And then you guys go out and find the best opportunity for this profile. What were some things that you were thinking about that you could have done instead of this? And why did you guys end up landing on this opportunity versus the other things that were out there?
We've continued to tell the market that we are aggressively pursuing AI, but we're no longer pursuing ASIC and Bitcoin mining. We believe that Bitcoin and Bitcoin mining allows us to capture and start like harvesting the value of megawatts immediately for a much cheaper cost. While AI potentially allows us to have a better, a better levered return profile on investment with more credible counterparties if we have kind of large hyperscale deals or large enterprise. And so when we think about growth for the business, it's how do we drive the best yield on dollars deployed? And how do we think about the velocity of those dollars deployed and how we're growing? Like these AI deals that you guys have seen from the market take longer to sign and take longer to build. If we have a site that's there, it doesn't take that much space. We can bring on 205 megawatts online in like 6 months. Why not just like pull the trigger and sprint at it and start generating yield on that land? And I think that also makes us more attractive to like, we do a lot of sites behind the meter, right? It makes us more attractive to those generators because instead of telling them, hey, why don't we start paying you in like 3 years from now or 2 years from now when we build out this data center, we can say, we can get this online really, really quickly. We can start solving your congestion risk at your wind farm. We can start helping you to kind of generate revenue. And then whatever use case of consumption happens doesn't matter to you, but we can evolve that over time. And so for us, like it's deploying capital thoughtfully in areas that we believe have a good risk-adjusted return. And we think like doing a deal like this, which gives us a path towards 20 exahash of self-mining within a flick of a switch when we have the site online, allows us to do so without having to spend hundreds of millions of dollars of our balance sheet money today to commit to that, where we don't know where hash price is going to be. We don't know what the market dynamics are going to be. And it gives us an ability to have a really good base case scenario and downside protection, but kind of uncapped upside because we can kind of convert it and mine Bitcoin if Bitcoin rips and goes up to $100,000 plus, and we have that kind of option value. And so I think that's really important, is not solving the problems just for today, solving the problems for where we think the market is heading, because ultimately we want to build a business that investors trust over time. And if we just solve for the problems of today, over time, I think we'll lose that trust.
Awesome. I think
trust short term, which we've learned because people will kind of not give us credit for solving problems in the future because they want immediate impact.
I think that's a good place to leave it, but I want to give the floor to you for a second if there's anything else we didn't cover. We went from like the ASIC itself all the way to the opportunity of different investment profiles here. So I'll leave it to you for final thoughts. Anything else?
I think I'm trying to find the right balance as a CEO. Look, I took over this role in February, and I'm trying to find the right balance on communicating the deals that we're doing versus just staying heads down and focusing on executing on those deals. And so you'll see me sometimes more active, sometimes less active. And that's primarily trying to find that right balance because, candidly, I love these calls with you. But when I'm on these calls with you, I can't work on doing the next deal, right? Yep. And so I think like for the market, it's us as an organization finding the right balance and communicating what we're doing, because a lot of what we're doing, I think, is bespoke and different from what people have traditionally done, but we think it'll drive the right returns over time, and it'll drive good risk management and how we deploy large sums of capital. I shared with you, like on the US Bitcoin side, we haven't raised a single dollar before Code 2 since 2021, right? And that's in a market where $5+ billion have been raised this year amongst our peers in the markets. And so how do we grow this business in a way that's really thoughtful? Before Code 2 invested, and like as of the last earnings, you guys saw we had almost $200 million on the balance sheet. So like, it's not like they invested and we deployed all those dollars. Like before then, on the Hut 8 side, which was a lot of the infrastructure that came into what Hut 8 is today from US Bitcoin, like on US Bitcoin, we had only raised $109 million of equity. Right. So we built this whole company on $109 million of equity. And now we just raised the Code 2 round. We're going to continue to fuel growth and momentum. But it's really thinking about how far we've gone with the dollars that we've deployed and being like really rigorous in continuing to keep that mindset. We'll need to deploy dollars at scale. We'll need to continue to grow, but making sure every dollar we deploy, we have conviction and the return of that dollar, and we're able to manage the volatility, because I don't want to just blame the markets and hash price for why we didn't succeed. I want to control as much of the destiny as we can. Yeah,
I kind of like that we're ending on this note. Actually, is a lot of times in the show we talk about like the financial levers for growing Bitcoin mining company, debt, equity, or Bitcoin. But below that, there's strategies, right? Where some people are just going self-mining on the extreme. Some people are doing like this cockroach model where they're like really trying to eke out a meager existence, Bitcoin mining, making these chicken hut coops and doing all those sort of things. And then there's people who are going into the AI HPC scene and really moving that way, maybe even like simping a little bit towards the like clean energy narratives. And then I think there's some other structures in there that are interesting. This JV model I really like, where you can take the risk off your own balance sheet and still be able to grow your hash rate. And there's only a few people I've seen that are doing something similar to this. So that's kind of cool to see something innovative like that. I'll leave it to you if you have a response.
I think by the end of next year, what success looks like for us is being a leading Bitcoin miner in terms of exahash and access to be able to convert those into self-mining if the markets are there. And so right now, we don't have a leading self-mining exahash number. And by end of next year, our goal is to be within one of the top miners that do with leading efficiency. And then on the AI side, to be building and having a contract signed and be able to execute and hopefully soon deliver one of those data centers as well. And so by end of next year, sprinting at both of those businesses and not cockroaching or tiptoeing around them, owning the growth and acceleration of those businesses.
Love it. Asher, thanks for coming back on the show. Always good to see you, and best of luck as you guys kind of get this deployment going.
Thanks so much. Appreciate it.